Hello, I'm Ian Horne from Citywire, and I'm joined in the studio today by Investment Director Andrea Young and Fund Manager Will Mcintosh-Whyte, both from Rathbones. We're going to be discussing model portfolio services and how they can help financial advisors navigate today's investment challenges. We'll also be exploring how Rathbones finds ways to differentiate and add value in a highly competitive MPS space, which leads me on to my first question. Andrea, with so many MPS providers in the market, what differentiates your offering from the rest?
So when the Rathbones and Investec combination came together, we saw this as a real opportunity to review our MPS offering. So the idea here is to really bring together the best of both worlds. So what we've done is we've applied an asset management lens onto our MPS solution, and that's really helped us to address the common platform issues. So the main enhancement that we've made is creating building block funds, and these are specifically for our MPS solution. This helps us to invest directly, so it broadens that investment universe, which enables us to enhance returns, and more crucially, it allows us to manage risk more effectively. From an operational perspective, it's been quite a game changer as well. So we know with an on-platform solution, if you rebalance at platform level, clients' assets to some degree can be out of the market for a day or two. So with the building blocks, being able to trade within these, it allows us to make changes quicker. It reduces the cash drag for clients, and it also reduces the possibility of potential CGT crystallizations.
Amazing. And Will, Rathbones MPS is built using a unique LED framework. How does this actually work, and what makes it different from other frameworks that are available out there?
Yeah, so as Andrea said, rather than the sort of traditional fund of funds framework, essentially we've designed and launched 3 unique funds based off our proprietary LED risk framework. So that looks to essentially categorise assets according to how they're likely to behave, particularly in times of stressed markets. So talk about liquidity assets, equity type risk assets and diversifiers, and the MPS looks to allocate across those 3 funds to ensure that each strategy has the appropriate amount of risk and diversification. So the liquidity assets, you have things like government bonds, high quality corporate bonds and cash, so expected to be the more defensive part of the portfolio, highly liquid as you might expect, so easy to buy and sell in any market environment, and also likely to have a negative correlation to risk assets in times of stress. Equity type risk, obviously investing in equities, but also those assets that are highly correlated with equities like low rated corporate debt, emerging market debt, high yield or private equity, targeted to be the sort of engine of growth of the portfolios, and then a diversifiers. And this is investing in both traditional diversifiers like gold and agricultural commodities, but also structured products where we're looking to essentially both hedge a risk or try and find an uncorrelated stream of return. And ultimately this diversifiers piece is looking to add that genuine diversification to the portfolios. Let's
put ourselves in the position of financial advisors now. What would you say are their biggest investment challenges at this moment in time, and how are you helping them to deal with those?
There are always plenty of challenges around, but I think probably at the moment is concentration risk. So if you look at global equity markets, you're seeing that an increasingly small number of funds or companies are making up an increasingly large amount of the equity index. The infamous Mag 7 make up nearly 20% of global equities now. And so if you're allocating either too passive or even too active, so managers might be targeting a sort of more market-based approach, portfolios can end up with very large positions in a handful of stocks. So for us, we look to take a more diversified approach and trying to ensure that no single equity or group of equities has an outsized impact on the portfolios.
Andrea, why is it important for an MPS service to offer real value for money, and how does Rathbones help to deliver that?
Yeah, so we've designed our MPS to be very cost effective, particularly in the active and hybrid space. So we're offering it a 0 DFM fee and an OCF cost cap of 50 basis points. But we know when we're thinking about offering value, it goes beyond just lowering costs. So what we've really tried to do is create a solution that focuses on those long-term returns and also being able to manage risk effectively. And that's what we can do with this building block structure. The other thing that we want to think about is how we offer support to advisors as well. So we've looked at our suite of support and we've enhanced our reporting, for example. So we offer full look-through reporting so advisors can see exactly what's under the bonnet and they can find out why. We've got monthly reports, we've got live webinars, and also our monthly podcast, so you can hear directly from the investment team. And really, it's all about providing advisors with that support that they need to service their clients. So it's not just about thinking about low cost, it's about being able to offer value beyond that.
I'm going to ask you one last question. You talk about the feedback you get from financial advisors. What's the question they're asking you the most at the moment?
I think from my perspective, it's really about there's a lot of uncertainty in the markets at the minute. We're seeing increased volatility, and really it's about finding a solution that they feel comfortable with, that they know that we are able to manage risk effectively and really support their clients and their hard-earned money over the long term.